Hello, everyone, and thank you for joining us. Today, we're going to cover stock options and equity compensation. The focus of today's meeting will be on advanced planning strategies for private company executives. Your presenters today are going to be Kristin McKenna. Kristin is a certified financial planner professional, also known as a CFP professional, and the president of Darrow Wealth Management. In 2023, Kristin was named to Investment News 40 Under 40 list. She is also a nationally recognized specialist in stock options and wealth compensation, with a particular focus on sudden wealth events. In addition, Kristin is a senior contributor at Forbes and is frequently published in national media outlets. She has also been featured in mystockoptions.com as a panelist for events around stock option financial planning. I am Matt McCreary. I am a CFP professional and a certified public accountant. As a wealth advisor with Darrow Wealth, I work with individuals in all stages of their career and throughout retirement. I leverage my experience as a CPA to help clients better understand tax strategies and potential implications around their stock compensation. A little bit about Darrow Wealth. Darrow is an independent, fee-only fiduciary specializing in helping executives around the U.S. with stock option and equity compensation. Through our wealth management program, we help clients navigate liquidity events, invest for their future, and tackle anything and everything in between. Before we get into the meat of the presentation, we do have to discuss a little bit about compliance. The purpose of this presentation is to provide a generalized idea around stock options and private company equity compensation. This is not a specific recommendation for personalized investment advice, legal, accounting, financial, or tax advice. Again, this is just for general informational purposes. Our agenda will focus on 8 key items. First, we'll start with tax treatment of restricted stock and stock options. We'll move on to AMT, alternative minimum tax, and AMT tax credits, cash considerations, exercise strategies and 83B elections, liquidity events, taking profits, and strategies for diversifying, Section 1202, qualified small business stock, and finally, putting it all together. To start, we'll look at how restricted stock is taxed. Now, it's important to note that restricted stock is different from restricted stock units, also known as RSUs. So please keep that in mind when I'm going through that. When you are granted restricted stock, you have an option to elect 83B or not. If you do not make this election, it has to be done within 30 days. There are no tax implications. Instead, you will be realizing tax at vesting. So assuming your restricted stock is on a time-based vesting schedule, that is when you will have to recognize or realize tax. And the taxes will be on the spread, or the difference between the value of the stock and anything you paid to purchase the stock. This is going to be taxable income, and your holding period for capital gains now starts. With the 83B election, what you will have to do is make sure you do it within 30 days of grant. And when you make the election, that is when your tax implications will start and your holding period will also start. If you make the 83B election, the spread or the difference between the value at the date of election and what you pay for the stock is going to be taxable income. And it's important to note that this is an irrevocable election and the tax paid is non-refundable. So even if you forfeit the restricted stock, you will not get a refund for any taxes paid. So it is a little bit of a gamble, but there are tax advantages for making this election, and I'll explain those in just a moment. So the tax implications, if you do not do the 83B election, or if you do the 83B election, come down to federal income tax withholding at the statutory rates of 22 or 37%. There's also Medicare tax, Social Security, and or a potential additional Medicare surtax. Your tax basis is going to be the fair market value of when you recognize this income for tax purposes. So if you don't do the 83B, your tax basis is going to be at vesting. If you do the 83B election, it will be on the date of that election. Now, one of the benefits of the 83B election is that you will potentially pay less in income because the value on the date of election will likely be lower than at vesting. Now, the flip side of that is you will pay more in capital gains, but capital gains are taxed at a lower rate than regular ordinary income. So that's one of the advantages of doing the 83B election. But again, you are taking some risk because you may end up forfeiting those shares. Next, we're going to move on to non-qualified stock options and how they are taxed. There is no tax implications at grant or vesting. At exercise, you will recognize or realize ordinary income. You will also have payroll tax withholdings, and you have the potential for state and additional Medicare tax. These taxes will be on what's known as the compensation element. So this is the value of the stock at exercise less the strike price multiplied by the number of shares you exercise. That is what you will be taxed on. That federal income tax will have very similar ramifications as restricted stock, and it will be at those statutory rates. There's also going to be Medicare tax, Social Security, and there may be more surtax that applies. Once you've exercised non-qualified stock options, you really have two options here for what to do with those exercise shares. You do have more, but for simplicity's sake, we'll just focus on these two. You can exercise and hold, or you can exercise and sell. If you decide to exercise and hold, any gain after exercise will be based on your cost basis. So the price you paid for the stock plus the compensation element. That's roughly the fair market value on the date of exercise. The determination for whether it is a short or long-term gain just depends on how long you hold the shares after the exercise date. There may also be a 3.8% Medicare tax on those realized gains on the date of sale. So just keep that in mind, that there may be additional tax implications based on how much you sell and how many or how much more realized gains you have in that tax year. If you decide to do an exercise and sell, there are no additional immediate taxation implications here because you don't have an opportunity for realized gains to build up because you're simply exercising and then immediately selling. It's important to note that the payroll tax withheld may not be enough to cover taxes owed. So do keep that in mind, that when it comes time to make an estimated payment or at year end, you may owe more to the IRS. Incentive stock options are more complex and do offer benefits to non-qualified stock options. And that involves the calculation of alternative minimum tax, also known as AMT. In order to better understand incentive stock options, what we're going to do is break this into two slides. We'll first get a better understanding of qualified versus disqualifying dispositions, and then we'll go through an example to just understand how AMT is calculated and how to use those credits in future tax years. Just like non-qualified stock options, there's no tax implication at grant or vesting. When you exercise, unlike non-qualified stock options, there's going to be no tax withholding. So there's no W-2 income recognized when you exercise an incentive stock option. This leads to the AMT calculation. Again, we'll cover that in just a moment. And in order for this AMT calculation to happen, you have to hold on to the shares until at least the end of the year in which you exercise. After you have exercised the shares, it really comes down to holding period requirements as to whether they will still count as a qualifying disposition. So in order for it to be a qualifying disposition, you have to hold on to those shares for at least 1 year from the date of exercise and 2 years from the date of grant. So that is an and, not an or. So both time periods must be met in order for it to be a qualifying disposition. A disqualifying disposition is anything before those dates have been met. And what ends up happening here is that you will owe taxes, but again, they will not be withheld in payroll tax. So it will count as ordinary income. And the way that tax is calculated is going to be the compensation element, which includes the bargain element, which is the value at exercise less the strike price. So essentially, what gain did you realize when you exercised the shares? And it will also be taking into account any actual gain that takes place after the exercise. So the compensation element is going to be the lesser of that bargain element or the actual gain from the sale. Again, you will owe taxes on this amount and it will count as ordinary income. Any gain above this compensation element is going to be considered a short or long-term gain based on the holding period after exercise. In addition, a 3.8% Medicare tax may apply based on how much realized gains you have in that tax year. Now, for a qualifying disposition, what ends up happening is we will calculate the spread between the exercise price and the sales price, and that will be a long-term gain. Again, this may take into account that 3.8% Medicare tax if the realized gains are significant. To better understand AMT and AMT credits, what we're going to do is walk through an example, but we'll dive a little bit deeper into the tax calculation of AMT. So incentive stock options can trigger AMT, and essentially you're prepaying taxes on the exercise of those shares. This is a parallel tax calculation, and you pay the greater of between the regular tax calculation or the AMT. So the regular tax calculation excludes the spread from the incentive stock option exercise and instead just the exercise price. It'll make a little bit more sense as we go through the example in just a moment. Under AMT, the tax due includes the spread and disallows itemized deductions. So that is important to note when thinking about AMT. You do not have an opportunity for itemized deductions here. There are two AMT tax rates to think about, 26% and 28%. AMT exemptions and phase outs were increased with the 2017 Tax Cuts and Jobs Act. However, those are scheduled to sunset in 2026, pending any future tax changes that may be enacted before then. So we will go on the assumption that they will sunset in 2026. We're going to get into a hypothetical example. In this example, what we're looking at here, and it's important to think that we are not including any other income. This is purely an AMT calculation for simplicity's sake. So let's say you have 100,000 incentive stock options with a strike price of $1 and a fair market value of $4. For regular tax purposes, you will have regular income of $0. The AMT income will be $300,000. So that is the spread between the value on the date of exercise and the exercise price. At 28% AMT tax rate, you would owe around $84,000 for AMT purposes. Now we'll get into the tax basis because they are different between the regular income tax calculation and AMT. So for regular tax basis, it is simply going to be the purchase price. So that $100,000, that strike price times 100,000 shares. For AMT purposes, your tax basis is going to be the purchase price plus AMT income. So essentially the fair market value on the date of exercise, and that will be $400,000. Now, this will lead to differences in how realized gains are calculated in the future for regular income tax calculation and your AMT calculation. This gets really complex, and that's why you'll want to make sure you're working with a tax specialist to ensure you're calculating AMT correctly, but also using those credits correctly for future years. So this is something that isn't just a one and done. You will want to make sure you're using those credits correctly in the future. So in years when you are not subject to AMT with regular capital gains, an AMT credit may apply. And essentially, this is, again, prepaid tax that you can use to offset those realized gains. This annual credit is going to be limited to the gap between the tax due and the regular calculation and the AMT that year. Any excess AMT can be carried forward into future years. So important to note that triggering AMT, even though it can be complex, isn't the end of the world. It's just something you don't want to do by accident. And working with a tax specialist can really help there. Before I pass this on to Kristin, I do want to talk about something that's really important when thinking about private equity compensation, stock options, restricted stock, anything that might be top of mind, is that cash rules everything. So you might be really excited by your compensation package and really excited to take advantage of this opportunity in front of you. But it's important to note that there is a cost in doing this. And having cash on hand can really benefit you, but we know that this isn't always going to be the case. You may not have enough money to buy those restricted stock shares. You may not have enough cash on hand to exercise those stock options. And so it's important to think about other options available to you. And there's also a difference between private and public availability to you when your company is public or private. So when thinking about liquidity, it's not just buying those restricted stock shares or exercising those stock options. You also have to think about taxes and how you're going to pay for those taxes. And that is something that can sometimes get overlooked. And just a reminder out there that you do have to ensure you are covering taxes when you are enacting or exercising these transactions. So the statutory rates at 22 and 37% withholding may not be enough if the spread is greater than $1 million. So you may owe additional taxes and you may not have enough withheld. If the company is public, there's a whole new world of opportunity available to you in terms of liquidity to exercise your shares or purchase your restricted stock. And that is cashless or sell to cover transactions. And you can also use liquidity with public companies to cover your taxes. That's a huge benefit for a lot of folks. Private companies, on the other hand, you may not have that available to you, and there may not even be a clear path to the IPO market. Last year, 2022, is an example of that, in which IPO market pretty much dried up, and it was very challenging for anybody in a private company to purchase their restricted stock or exercise any options because there just wasn't enough liquidity in the market to do that. Another option is financing. This might be appealing to take out debt to buy restricted stock or exercise your options, but there is an increase for potential risk given that interest rates are at an all-time high right now, and you may be paying a lot based on those interest rates just to exercise your equity compensation package. And there's no guarantee that the price is going to go up after you exercise. So there still is risk that you may take a loss and you now have debt out there to cover that exercise or buying those restricted shares. So what we want to do is advocate, don't buy at any cost. Really think about what is the debt you're taking on and what is the potential benefit to you, and be wary of all financing. So whether it's company provided or it's private, leveraging family and friends, that could lead to detrimental impact to your relationships with those people. Taking on a HELOC or a home equity line of credit, that can be rather expensive, or a private loan. So these are some options out there, but we really want you to take into consideration what is the risk of taking on that debt just to exercise your shares or purchase restricted stock. Always remember that there are risks involved.
So now we're going to cover exercising stock options and some strategies there. So as discussed earlier with stock options, they are something that you must purchase as the option holder. So you do get to make some decisions. Do you exercise your options and actually buy the stock at all? And if so, when? There's generally two time frames that you would exercise the option should you choose to do so. An early exercise and a regular exercise. So an early exercise, if it's available and an option to you within the plan, is something that you're able to do before the shares actually vest. And we'll get into this in a lot more detail in the next couple of slides. The regular way to exercise your stock options is after they vested, but before they expire. So this is a really commonly misunderstood area in terms of that expiration time frame. You can't be late. So if you are to leave the company before the 10-year initial exercise period that comes with non-qualified and qualified stock options, you don't have that same time frame, or at least not automatically. So generally, companies will give you between 30 and 90 days to actually exercise those options after you've separated from service. So again, remember that original 10-year expiration date on the grant, it definitely doesn't automatically apply, and companies seldom give it. One thing that's also important to note here for ISOs is there's actually an IRS statutory limitation on how far out into the future those could be exercised after you leave and still considered ISOs. It's 90 days. After that, if the company is willing to work with you and if you've negotiated for a longer time frame to exercise those options, which it is a negotiable aspect, they would simply become non-qualified stock options at that time. But again, another thing to think about here, if you are planning to leave, is if you were at a public company, for example, and if you're able to do a cashless exercise while you're still there, those options wouldn't be available to you once you've left in most situations. So we're going to go into the early exercise and how that works in the next couple of slides with some examples. So there's really one reason that someone would consider an early exercise, and that is the potential for tax savings, and sometimes major tax savings, by shifting their taxable gain more towards that long-term capital gain bucket and less for short-term capital gains or ordinary income. The other main reason is to start the clock on qualified small business stock, that 5-year holding period, and then, of course, for the long-term capital gains holding period, either non-qualified stock options or ISOs. So incentive stock options are most commonly known for their tax benefits. However, when it comes to what vehicle is the best one for early exercising, it's not usually ISOs. And it's because of that holding period that we discussed earlier, that 2-in-1 holding period. So in addition to that, there's also a limit on how many, the value of ISOs that can be considered exercisable in a year before they become non-qualified stock options, and that there's a $100,000 limit. So if you're given a big grant, it just wouldn't qualify if there are those early exercise provisions, which is another thing to be aware of. Unlike ISOs, non-qualified stock options and restricted stock awards, you only need to hold those for 1 year to get long-term capital gains tax rates. So we've had clients where we've actually suggested they request this type of equity comp instead of ISOs if they are looking to do an early exercise. And sometimes companies will work with you on that. As mentioned earlier, it has to be permitted by the plan. Not all stock option plans allow for early exercises. And making an 83B election is a really, really key part of this strategy. As we discussed earlier, the 83B election is you officially telling the IRS that you wish to recognize income on this exercise when you aren't vested. So it kicks off this whole process of cementing the holding periods that are really important. There's a strict filing deadline for the IRS. It's 30 days after exercise. You can't be late. It's just non-negotiable. So don't forget about that. But without that 83B election, you don't actually start to have the clock tick on that long-term capital gains tax treatment. And it actually can have some pretty adverse consequences in terms of when income is recognized, which we'll get into in the next couple of examples. So here again is, we have several very, very simplified, very hypothetical examples. We're not even using cumulative values here because there's just so many complexities at play that could happen with the rest of your tax situation and specifics of the different grants. This is just designed to give you an idea as to why you might want to do an early exercise and the power of an 83B election. So in the next few examples, we're going to use a lot of the same initial assumptions. The strike price is $1. The 409A valuation of those shares at the time that you do the early exercise is also $1. So if we have ISOs and we've done an 83B election, we're doing an early exercise using those facts, the AMT income at this point is 0 because the spread between the strike price, the purchase price, and the current value of the shares is 0. So this particular grant has a 2-year vesting. Half of it vests after the first year and the second half vests after the second year. So now let's assume we're in year 1. The valuation of the shares is $3. There's no tax impact at this point because we're not selling anything and we've already done the 83B. Fast forward year 2, the valuation is now $10 a share. So now at this point, the qualified holding period will have been met on all of these shares because we're 2 years from grant and at least 1 year from that exercise date. So again, the minimum holding period time in this example is 2 years. Let's just assume we sell at this point for the same price, $10 a share. So at this point, there's a long-term capital gain on the shares, which is calculated very simply. We just have the price that you sell it for minus the purchase price, which is $1. So it's a $9 per share long-term capital gain. Now let's look at what would happen if we also had ISOs, but we did not do a timely 83B filing. So now there's no tax implications at the early exercise because you haven't officially recognized that income. However, in year 1, when the first half of the shares vest, now you do recognize AMT income, and that is on the spread. So because the new 409A is $3 and we didn't file the 83B back when we early exercised, as the participant, you would be subject to recognize AMT income for whatever that value might be once the portion of those shares vest. So this can create a lot of headaches for people, especially if there's no liquidity and if the AMT is actually triggered and tax is due. The other thing to keep in mind is that when you have incentive stock options, if there is an AMT spread, you do have AMT income and you trigger it, you actually can have a dual cost basis that emerges. And that's just something that you'll want to work with your tax advisor and financial advisor on to make sure that you're tracking. But as discussed earlier, the differences in the cost basis can be significant under that regular system and under the AMT system. So in this example, if we're assuming that this individual did actually have to pay AMT in year 1, their cost basis under the AMT calculation would be $3 and their cost basis under the regular system would be $1. And this will come into play in year 3 when there is a sale, because once again, you'll need to calculate your subsequent gain or potentially loss. But here we're using a gain under both tax systems because AMT is a prepayment of tax. You might actually end up reducing your gain later on. So now in year 2, once again, the 409A is $10 a share. And once again, you have triggered AMT income on that spread because it is vested and you didn't do the 83B. So at this point, you have met that qualifying disposition holding period for the ISOs. But that is only for the shares that have vested in year 1. Because remember, without the 83B, you don't actually start the clock ticking until the shares vest. So now you need to hold the shares for 3 years, an additional year, in order for 100% of them to qualify as a qualifying disposition. So now in year 3, once again, we sell for $10 a share. We're just using that same value throughout here for simplicity, as this is a hypothetical simple example. And again, we have now 2 cost basis calculations. So if you did have to prepay tax because you were subject to the AMT, you might have an AMT credit. There might be a carryover, and you can use that potentially when you do sell the shares to maybe eliminate a taxable gain that you have, maybe reduce it. But again, those are subject to limitations. So you would need to have a regular tax bill that is higher than your AMT tax bill to even use any AMT credit. And then, of course, you would be limited to the gap between what you'd owe under the regular system and AMT system and have a limitation of what that carryover is. So it gets really complicated really fast. There are strategies around planning which lot of shares to sell when to accelerate the use of that credit. This is a whole nother webinar in and of itself, but just something to be aware of and certainly talk to your tax and financial advisory team about. So now let's go to a non-qualified stock option example. We also early exercise, and here we're assuming that we've done the 83B. And just to note, if we had done the same thing, but with restricted stock awards in this example, the same tax treatment would follow. And again, just as a reminder, you cannot do an 83B election or exercise restricted stock units at all. This wouldn't apply there. So we have the same figures here. Again, when you exercise restricted stock and non-qualified stock options, it does trigger regular income, payroll taxes, Medicare on the spread. This is an example where it might make sense to early exercise because the spread is 0. So this is a benefit. We don't have any AMT considerations to worry about because we're not dealing with ISOs here. So after year 1, now we've met that long-term capital gains threshold for the half of the shares that have vested now. So that's terrific. You don't have to wait quite as long. Year 2, now all of the shares meet that long-term capital gains tax treatment, and we're actually able to sell for 100% long-term capital gain without ever having paid regular income tax on this transaction. So this is a prime example of when it might make sense to consider an early exercise when the taxable spread is low or 0, and the cash outlay to actually purchase the shares is also very low and manageable as well. Of course, if you had 500,000 shares or something like that, that might be a little bit expensive, but we work with clients all the time that might have a penny as a strike price. So that again makes it risk adjusted, could make a lot of sense. So what are some of the pros and cons of an early exercise strategy? Again, the potential for big tax savings rather than exercise when the gap is $9 a share. If you can exercise when that taxable spread is $1 or nothing, it really can be a tremendous savings. Again, it starts the holding period for not only long-term capital gains, but Section 1202, which is called qualified small business stock. We will get into that in the next couple of slides, but it's an incredible part of the tax code that is little known. One silver lining to down markets is it can actually reduce that taxable spread. So if you have a down round in this example, where now the 409A isn't $10 a share, but maybe it's $7, well, that can reduce, again, your tax impact. But it's not without risks, right? So leaving the company is one of those risks. The company is actually able to repurchase those shares from you at terms that aren't very favorable to you. So it's usually the lesser of your purchase price, the strike price, or the value of the shares at that time. And if you did make that 83B election, as is common, there's no refund on that tax paid. So you, again, need to keep in mind what your value at risk is in terms of your purchase price and the taxes paid. Mergers and acquisitions, not something that you can control, but that can screw up your plans, essentially. It can trigger a disqualifying disposition of ISOs. It can trigger short-term capital gains, restricted stock or non-qualified stock options. So it's just another thing to be aware of before you decide to do this or not. Stocks don't only go up. We for sure have seen that in the last couple of years, but shares can go underwater, especially if you aren't an early employee with that strike price under $1. We've very much seen it happen where individuals early exercise and now all of a sudden the value is lower, or they are just holding on to the stock and the value is still lower. So those shares aren't worth anything because they're underwater. If you did go ahead and early exercise and those shares become underwater, if the company decided to do something like a repricing to make sure that those equity incentive options still had value because they're trying to be golden handcuffs, they're trying to be trying to help employees stick around. If they end up repricing them to sort of fix that problem, you won't be able to participate because you already exercised. Again, there's always an uncertain path to liquidity and an unknown outcome for the stock. So it's just not reasonable to assume incredible growth rates over time, but it can be a really great strategy in all the right situations. So let's talk about going public. Most companies exit either through M&A or an IPO. Exercising right before an IPO is not usually the best strategy. It's happened many times where I get a call from a prospective client and they say, oh, I think my company is going to go public in the next 6 months. Should I exercise now? And usually the answer is, well, what is it going to cost you? It tends to be a high watermark in the company's historical valuation before they go public, stands to reason. So in this example, the taxable spread can be massive if you're an early employee, triggering a huge AMT tax bill or ordinary income tax if it's restricted stock or non-qualified stock option. Or if the person isn't a long-term employee, perhaps they just joined in the last couple of years, well, they still could have a really, really high strike price because that would have been given at the value at the time. So even if they don't have a large taxable spread, they could still be looking at a purchase price of well over $1 million, and it's just not feasible. The other thing to keep in mind is, again, stocks don't only go up. So Jay Ritter, University of Florida, he is the absolute foremost expert in all things IPO statistics, and here are some really good ones. So average IPO returns versus similarly sized firms, according to his research. The first 6 months after the company goes public, the new IPO tends to outperform modestly by about 1.2%. In months 6 to 12, which not surprisingly coincides with the share release, those new IPOs underperform on average about 4.6%. Supply and demand, there's been plenty of studies that show that the flood of shares hitting the market has price pressure. Unfortunately, for employees or stockholders at newly public companies, it doesn't get that much better in year 1 and 2 relative to similarly sized firms. So it is just something to keep in mind as you are considering how to take profits, which we'll get to on the next slide. And what you want your continued exposure to be is not underestimating the volatility of this concentrated stock holding. So when a company goes public, one of the things that you can consider doing as a strategy is using the calendar year to your advantage. So don't blindly think that just because you have incentive stock options and there is a tax benefit of long-term capital gains, if you hold it for this 2-in-1 holding period, that you have to do that. You don't. So one of the things that can make sense, if you know an IPO is coming, you can exercise early in the year, maybe in Q1, and reevaluate towards the end of the year to see what your AMT tax bill might be if you don't sell the shares before the end of the year. By exercising earlier in the year, the idea would be that any lockup period would have expired by then and you would have liquidity. Of course, it's not perfect, so you would want to put that into your calculation. But if you would trigger an AMT tax bill that would be just too large for your comfort, or you simply just need liquidity to pay for it, well, then you can actually just do a disqualifying disposition and recognize regular tax on that spread, because if you don't own the shares at the end of the year, then those shares aren't subject to the AMT. So you can also see what your tax situation is for all of your other income at that point. Once it's later in the year, more of that is known, and make a determination as to what makes sense for you. So the lockup period, this is usually 180 days, and it's important to note that it will extend very often to not only current, but former employees as well. So during this lockup period, you are essentially unable to sell, pledge, hedge your position. You might not be able to do a cashless exercise during this period as well. Most often, you're not able to even move the shares out of the custodian that they're currently being held at until this lockup period is over and those shares are actually released. As a best practice, if you leave an employer and you take shares with you, you've exercised them, keep your contact information updated with this current employer. They are going to mail you, email you all the information that you'll need about the lockup, the expiration, whether it applies to you, where your shares might be moved to, how to get them out of there. It's just a wealth of information. And again, as a best practice, before you leave the company, download all of your stock grants, all of that information from whatever system they're using, because you could lose access to it. Keep in mind, as a current employee, once the company goes public, expect blackout periods. It's standard for that to happen around earnings releases. You could also be considered an insider. And even if you're not to the level of an SEC insider, you still might have a role at the company where you have blackout periods. Those can extend all year. I mean, having material non-public information really can apply to a lot of different people. So just keep those types of things, again, that you can't control, in mind when you are relying on selling shares for liquidity, perhaps to pay tax, because you might not have it. Again, insiders would have a host of other considerations, filing requirements, potentially wanting to use a 10b5-1 plan. That is outside of the scope of this, but certainly something that we do regularly work with clients to support them on. So now let's talk about taking profits. So turning paper profits into real diversified gains. That's what we mean by that. It's so important to have a plan in place to diversify. And again, stocks don't only go up. There's a stunning statistic here from JP Morgan. Between 1980 and 2020, nearly 45% of all companies that were ever in the US stock market, as judged here by the Russell 3000, experienced a 70% decline in price from the peak and never recovered. We have seen this with clients over the last, let's call it 2 years. It happens. We have way more people in our client base than we would like that it has happened to. So this is very real. When we cite statistics as financial advisors about how the market moves and the benefits of investing over time, that applies to the market, but it doesn't stay the same for one single company, right? They don't move the same. One company is going to be much more volatile, upside and downside, than the market. So it's just so important to recognize that and to not pre-spend the proceeds, right? Because when you are holding onto that concentrated position, maybe it's worth $10 million in your account, but you haven't sold it yet. So that $10 million in this example, right, could become $3 million. And if you buy that expensive house or the boat or what have you, if you pre-make that lifestyle decision, then the money could potentially not be there for you, and it could put you in a really, really tough spot. So as we are talking to clients about what price targets should be and when they should sell and exactly how they should get their arms around that, one of the things that I think is helpful is to consider base, best, and worst case scenarios. So one of the things we often hear is, I don't want to sell now, I want the stock to recover, or I think the stock's going to go up, I don't want to sell now. Okay, so let's walk through this. Let's assume that you could sell that stock today for $1 million, and that's just the base case because that's what you could currently do. In the best case scenario, let's assume that it could go up by 50%, which is huge. That's an incredible gain. And you could sell it for $1.5 million. Certainly better than $1 million, yes. But now let's assume that the worst case scenario is the stock actually goes the other way and it gets cut in half. And all you get from it is $500,000. There's no reason to assume that one of these situations has a higher probability than the other. So when faced with $500,000 or $1.5 million, or just the known quantity of getting $1 million today, that base case really doesn't look so bad anymore. And it's something that you can control. So just really try and be honest with yourself about what the likely outcomes are and make sure that you're comfortable taking that risk should you choose not to sell when you're able at the price that is prevailing in the market. It's very common for employees of either whether they're a current company or whether it's a former company, when they have a large holding there, they tend to be very bullish on that stock in general. So one of the things I like to ask clients is, if you were given a cash bonus today, what would you do with it? Would you buy more stock from this company? I've never had anyone respond yes. So that should just be telling to you that when you see this stock is worth $1 million in your account, is that $1 million more valuable to you, or holding on to the stock and taking that risk in the future? And it doesn't need to be all or nothing. It doesn't mean you need to sell all of it in order to achieve that diversification. But if you have more than 10% of your net worth tied up in this stock, as most people with concentrated positions do, they're taking on a lot more risk than they perhaps will want to when looking back. So there's some different strategies that we'll use when working with clients to diversify a concentrated position. A lot of these do require a really robust investment process, financial advisory team, and even a trading team to manage them. We will work very frequently with the institutional trading desk to actually execute a lot of these options when they're available to clients. So it's not something that we would suggest doing on your own. Also do want to mention that these options not only wouldn't be available during the lockup, but might not be available if you're a current employee, as those individuals are usually limited in anything they can do from the option standpoint. But just to walk through a couple of these strategies that you might want to consider. So a limit order. A limit order is setting a price target for a future sale in this example. So let's say you have a stock and it's currently trading at 15. You don't want to sell it till it's worth 20. What you could do is put in a limit order, and that order would trigger before it expired, which you can usually go out, 6-8 months or something like that, and say, hey, when this stock gets to at least 20, try and sell X number of shares. Another strategy, which we really like a lot, is called a cashless collar. Now, what this strategy does is two things. It allows you to sell a call option. So following on the existing example, the stock is trading at 15. Perhaps you sell a call option for 20. So that means that you are selling to some other investor in the market the right to buy that stock away from you at $20 a share. In exchange for that, you can purchase a put. So that's the other way. So if the stock's at 15, perhaps you are purchasing the right to sell that stock to someone at $10 a share. That's expensive. So usually it doesn't make sense just to purchase the put, because the cash outlay can be very considerable. And either of these strategies are only in place for a certain period of time, usually just a few months. So it's short-term protection, but by doing the cashless and selling that call option, in theory, at a price you'd be happy taking anyway, it can really make it either so that you don't spend any money doing this, or at least drastically reduces the outlay while you wait for a more favorable time in the market. Although it doesn't provide you any downside protection, one of the options that you could also consider is selling a call option. So the first leg of the last example, and that will just provide you income while you wait for that call option. If it gets called away, again, in theory, it's at a price that you're happy with, but if it expires out of the money, perhaps at $16 a share, then nothing happens and you still just get to keep the income. So that can be another strategy. A market order is just, the base case over on the left side here of just selling at the prevailing price. There can be different strategies we'll consider, whether we just do it all at once, whether we try and do it over time, whether it's a dollar amount, we're looking to stay with under a tax threshold for the year. There's a lot of different things there. But again, we've run into a lot of different issues in working with clients. So it's important to recognize that your situation will be different. It just will be. The option strategies we discussed, they're not available for every client. Perhaps the company just doesn't have an options market, right? So typically companies need to be of a certain size and have enough volume and interest to even have an options market for it. So if it's a smaller IPO, it's very unlikely that that would be something you could consider. You also need to consider liquidity. So that's the idea of not your liquidity, but how liquid the stock is. So again, if it's that smaller company, they may not have a lot of shares that are exchanged day-to-day basis. So we've had a client that had a few 100,000 shares, and ideally he would have loved to have just hit sell and exited the position in one day. But in this example, there are only about 50,000 shares that were changing hands every day. So he couldn't exit the position without drastically moving the market and driving his price down. So these are some of the things that we will consider, again, in working with the trading desk and really making sure we're keeping a keen eye on the client situation, considering blackout periods, insider rules, all that sort of thing. So another option to try and mitigate risk is managing the rest of your portfolio around a concentrated stock while you are trying to diversify. So for example, if you're working at a big tech firm and that's where all of your stock is, perhaps we would be managing your portfolio without investing in the NASDAQ QQQ, for example. So that's just another thing you can do to try and reduce your risk. And finally, just can't stress enough the importance of a one-time nature of a sudden wealth event. So you can only spend $1 once, really being thoughtful about how to spend, invest, and enjoy the proceeds from this liquidity event. The importance of that just cannot be stressed enough. Mergers and acquisitions. So we won't spend a ton of time here because pretty much anything can happen. And that's really just the point of this slide, is just to illustrate some of the different factors that make it impossible to know what could happen to your shares that you own or just your unexercised options in the event of M&A. So the terms of the deal will ultimately dictate what will happen, but those aren't announced until the deal is finalized and publicly announced. So is it an all stock deal? Is it an all cash deal? Is it a blend of the two? That has a huge impact on what will happen. If it's cash, then you will be cashed out. That cash could still be subject to vesting though, right? So there's so many things that can happen. Sometimes people are able to get tax-free rollovers of their equity. Sometimes equity will be converted or substituted. There could be a full or partial cash out. If the options are underwater, they might actually just be canceled. Again, there's a lot that can happen. And as discussed earlier, these things have implications for employees who exercise their options early. So usually when there's M&A, there will be some human capital changes. We found that generally takes about 9 months to sort through. During that time, you could potentially still be vesting. So as you're thinking about your next opportunity or whether or not there'd be a place for you, do that math and make sure that you understand what you potentially would be leaving on the table if you were to depart, knowing that when there are layoffs, you would likely have more favorable terms, maybe even severance package. They could accelerate the vesting of shares. So there's a lot to think about here. And then last, getting paid out in cash in a lump sum, it's really not the worst thing. Can you control the taxes around it? No, but all of your risk is off the table, and you could have a major windfall as a result. So we're almost done here. And in the last slide, we're going to talk about a really exciting thing called Section 1202, qualified small business stock. This is a tremendous part of the tax code. It is not very well known, even amongst the financial planning and tax advisory community. So it's really, really important to make sure that you are working with a financial advisor and an accountant and really have the legal advice of the whole team to manage the strategy for you. So with Section 1202, if you qualify, you have the potential to sell all of your stock holdings and recognize no taxable gain. So it's tremendous. It has happened before, again, where we've had a new client come in and we were able to identify that they actually had stock that was likely going to qualify for this, but their previous financial advisory and tax advisors had not made any mention of it or wouldn't opine about it. So finding this out and actually getting them to work with another professional who could make that determination at that point would have saved, about 7 figures in taxes alone. So this is a really, really incredible opportunity. And it's just important that as the taxpayer, you're making sure that you understand whether or not you qualify. So at a high level, the gain exclusion has 2 components. There's a $10 million cap, which is a lifetime cap per taxpayer, so per person and per issuer. So if you're a serial startup employee, that cap could apply to all the different companies. There's also an annual limitation of 10 times basis, and we'll explain that a little bit more in a minute. So every year, the exclusion is evaluated on both of these terms. So once you exhaust the $10 million kind of one-time cap for that issuer, you could still exclude some of the gain by that 10 times your basis. That's calculated annually. Most of the folks that we work with have such a low basis that second part of the calculation doesn't really offer that much value, but it's still good to be aware of. Another thing to be aware of is that states may have their own qualified small business stock rules. They may conform federal, they may ignore it. So it's, again, really important to work with a CPA and a tax advisor to discuss your situation. So how do you qualify? Here are some of the key requirements. It's not all of them. Making sure that you get that documentation in place is pretty complicated. We'll talk about that more in a minute. But just as a high level, the stock must be acquired directly from the company, and that has to be a domestic C Corp. At any time, right around when those shares were issued, the company's gross assets has to be under 50 million. So we talked about the early exercise strategy. This is one of the reasons to consider that, is because if you wait, then there is a potential that company's gross assets would exceed that $50 million mark by the time you actually exercise your stock, which is what's important in determining whether or not you would qualify for Section 1202. There's a 5-year holding period. Again, it's the date that you acquire the stock. So it's really important that you do that 83B election or just make sure that you're vested. 80% of the corporation's assets must be used in qualified trades or businesses. You can look it up exactly what that is. And any significant stock redemptions can disqualify the shares from meeting the requirements. So there is no IRS checklist to make sure that you've documented everything or to determine whether or not you qualify. This is something where if you're ever audited, you need the documentation to substantiate your claim. So that's why it's really important to gather the documents as you go. Because if you wait till you think you've already met this 5-year holding period, then you're trying to go back a minimum of 5 years to justify that gross asset, the stock redemptions. I mean, all of these things, there could be turnover at the company. We've seen it. It can be really hard. So as a best practice, we always suggest working with a tax attorney, working with a CPA and your financial advisor to understand what types of documentation you might want to meet and actually get a determination. If you can't get that documentation, you're going back really far back in history, consider doing it's called a QSBS study, essentially hiring a tax professional or an attorney to work with the company and really try and formally document this. Carefully monitor your own holding period. It's up to you as the taxpayer. Another just thing to think about here is there's been many legislative attempts over the years to curb or repeal qualified small business stock. The last one was about 18 months ago, is at the end of 2021. So as you think about when to diversify, how much to sell, really do keep in mind that the tax code is only in place for today, really, because they change it constantly. So those rules can constantly change, and you don't want to be making decisions on the future based on the current tax code, but you assume that it's going to stay forever because they change the laws. And we already know that in 2026, the current rates are set to expire. So putting it all together, as an individual with equity compensation, you're likely aware that there's a huge potential for life-changing wealth, if not multi-generational wealth. But a lot of things have to go right. And there's a lot that can happen where, if you don't know what you don't know, you might not be making the right decision. So it is very likely that these sudden wealth events only happen once in a lifetime. So if you've never done it before, how do you know you're going to get the best outcome? So we are just big proponents of getting the team together as early as possible. And that's, the financial advisors, that's the tax professionals, usually a CPA, and then the legal advisors, potentially too, to make sure that the strategy is being managed at the highest level. We see ourselves as wealth advisors as the client's quarterback. So even though we're not doing the tax return or drafting these estate planning documents in this example, we have such an ongoing relationship with our clients that we're able to bring those different parties in when things change in our client's life. And some of the things that we'll regularly work with clients on is strategies to negotiate equity. Maybe it's before they leave the company or in their next position. Again, those exercise strategies, how to allocate and manage those proceeds and the tax implications going forward, and really what that means in terms of the diversified proceeds for the rest of your life. Once the sudden wealth event is properly diversified, it doesn't end there. It's really just the beginning of what's possible and making sure your financial situation is being managed at the highest level. So if you would like to speak with us about your situation, please don't hesitate to schedule a call, reach out. Again, this is what we do. We're sudden wealth advisors, so we would love to help. Thank you for joining.